So a very warm welcome, everyone, to the weekly credit risk and credit as an asset class tutorial. Today is May 12, 2018. I really enjoy running the tutorials or helping on this course. I never run out of things to talk about. If you give me a 3-hour tutorial, I can still talk for 3 hours. But anyway, I got a few things I'd like to share with you today, which will be very useful. Not only useful, actually quite important for you to understand. First of all, by way of just housekeeping or administration, the first thing I want to point out is that I am recording the tutorials weekly, and for the last 5 weeks, if you go to the slides, you click on the link, then you can see the tutorial for that week. And I am doing that now as we speak, as you can see. That's the first thing. Second thing is that hello. You know, I use OneNote to make the notes sometimes. So for the last 5 sessions, these are the notes. Now, I don't know whether you find them useful, but if you do, if they're going to bring back memories in the class, then I'm happy to share with you. This morning, I actually sent out invitations to all of you to share this notebook. Did you receive my invitation? You should see that maybe in your email. Okay, so I don't actually have to. Whatever I do, okay, it should be either real time or after an hour you can see that. If you are a OneNote user, that's the second thing. The third thing that I want to mention is that you are going to see Ryan you're going to see him 4 more times, okay? And 3 out of that 4 times actually will be away from Admiralty, okay? So the next time you see Ryan actually is on the 20th of May. So next Friday, there is no lecture, okay? 20th of May is actually a Sunday. We are going to meet in YIA LT5. So sorry to drag you out on a Sunday, but you get your Friday night free. Just do whatever you want, right? And then after that, 5 days later, we will meet again in Admiralty, okay? 25th of May. 2 days after that, so it's going to be like a double. 2 days after that, we meet again in YLT, so that's going to be quite intense. And then the final, and this is just recently, okay? The final lecture will be 3rd of June, which is also a Sunday. We have not fixed the place yet, but quite likely it'll be somewhere in YIA, okay? Is everyone okay? Yeah? So next Friday, please don't go to Central unless you want to go to Lan Kwai Fong for a party or something, okay? Now, I thought about this, and I was thinking that, well, then let's try to, I'm trying to make you, or not make you to come in on Saturday. So next week, I will change the tutorial. So you don't have to come in on Friday, you don't have to come in on Saturday, okay? So you just come a little bit early to the same place, and then you just make one visit. Is that more efficient? I think so, okay? And I may well do it again on the 27th of May, change this, but I'll let you know. Okay, I'll let you know. Then you don't have to come in on. I know some of you do if you are doing behavioral finance and if you are doing modeling, but otherwise most of you don't have to. Okay? So we'll do that. Yeah, I'll let you know. Okay, but for next week, the only thing you have to do is come to, if you want to come to the tutorial, okay, or the lecture, just turn up on Sunday morning in YIALT 5. Okay. All right. So that is by way of the admin. Okay. Now for the tutorial this week, I want to mention a couple of things which are of great interest, and it goes a little bit further, and it's something what I call annuity value. Okay, now you should really know this by now. If there are very simple interview questions that you can ask a candidate, practically it doesn't matter what kind of job you're applying for. This is such a general knowledge question. If there are general questions you can ask a candidate as a kind of filter, not to test if they are really good, but to test if they are really bad. Okay? This would probably be one of those questions. Now the question is this. The question is, okay, if I ask you to give me $1 every year for the next 10 years, how much are you going to charge me up front today for you to do that? You can't say zero, okay? You're not a charity, right? Well, how much would you charge me? You understand the question? So you give me $1 every year at the end of the year, starting next year, 10 times. Today you can charge me, or you should charge me. Okay? How much would you charge me? You all know the answer, right? You're just too shy to put your hand up. Am I right? Did you hear my question? So if I was to ask you to give me an approximation, what would that answer be? Just an estimate. I know we need to discount. Everything is about discounting. Everything. But what would be the approximate answer? Or what drives the price? What is the key determinant of the price? Discount factor. And what do you think the price would be, just approximately? $3.75? I'm kidding you, it's nowhere near that. What would it be roughly?
would be an estimation? If I'm, yeah. 1 year, $1 a year. It could be 1 million if you want. I want someone to pay me $1 million a year. 0.8. So yeah, no, don't be shy. That is a good ballpark, right? It's about it would be around $8 first of all. Okay? When you say 0.8, I assume you mean that. If ever you ask a simple question like that, be positive, be fun. You know what they say about lawyers? Sometimes wrong, never in doubt. Okay? That's what you should aim for. Yeah, so now what is that driven by? It's not going to be 8 all the time, first of all. It will be somewhere, I think, between 750 or 7. Hello, it will be somewhere between 7 and maybe 850. Okay? Now, as you guys were kind of circling the answer, it is driven by interest rates. Okay? So depending on the actual level of interest rates, okay, that number, it can change. Okay? Now, I'm not asking you these questions to give you a hard time. You need to know simple. You're going to be using it practically every day, every week, I can guarantee you. When you're in banking and someone tells you, okay, well, my net interest margin is 22 basis points over 7 years on $1 billion. That in cash today, okay? You practically have to work it out in your head within 7 seconds. And traders, not only traders and some good salespeople are very good at that. Well, actually, it's simple. Okay, it's just arithmetic, and are you commercial enough? But the concept behind that, all right, is called annuity. Okay, annuity just means you get something. You get some income every year, and there's an insurance product, called annuity. Now let me, and I actually want to show you. I'm going to go through the example that Ryan was scribbling, not yesterday, but last time, right? And I saw some of you guys were just, you looked a bit lost in space. So I'm going to try and go through that. But before we do that, all right, you have to at least be comfortable with this. And so we do a very, very quick review of just the meaning of 1 basis point or $1, a million, doesn't matter, okay? So if I pay you $1 or 1 basis point per annum for the next 10 years, how much would you pay me? Now, there are 100 different names: present value of an annuity, annuity value, annuity point, sometimes called DV01, delta value per basis point, sometimes called PV01, PVBP, modified duration. Can anyone think of another name for this? The names don't matter. I always say to you, okay? In finance, people put different labels on the same concept. It's the concept itself that you have to be familiar with. Okay. Okay, so don't worry about the names. You see this all the time in bond land, bond world. Okay.
And in fact, you can extend this argument not only 10 years, but forever. Forever is a long time, but there is a formula. So if it was, well, $1 is easier to relate to, okay? For 10 years, then it would be, so the PV of that, okay, it would be approximately, let's just say 7. Let's just say 7, okay? So that means the duration, or the modified duration, or the value of 1 basis point, for those of you who have done fixed income, is somewhere around 7. Okay? Now, what if I pay you forever? I pay you $1 a year forever. How much is it worth today? This is just by way of general interest. You do know that, right? The answer is not infinity. Whatever you say, do not say infinity. You know what it is? You simply divide by the interest rate to infinity. Well, there's no such thing, but in an upward sloping yield curve, it probably will gravitate, it will converge to some kind of value. If the interest rate was, let's say, 2.5% per annum, all the way out to perpetuity, okay, then it will simply be 1 divided by 0.25, which is $40. Okay, but don't worry too much about that. It's actually the first question that this one I want you to keep an eye on. Okay, now that is the first thing. The second thing I do want to impress upon you. Some of you guys were wondering. So let's say you do an interest rate swap, just a single currency, okay? Now, party A, party B, so let's say, okay, let's keep it real simple, okay? And I'm gonna start with an example of a 1-year interest rate swap. So everybody knows what that is. So A will pay B, let's say a floating rate, based on 3-month US dollar LIBOR, and B will pay to A a fixed rate. Don't know what it'll be, but let's say 1.3. Okay. Now, one thing you may not have thought about, and this will be very useful for you. Okay? I don't know if anyone else will tell you in the future. The thing is, what you are, okay, you might have seen these diagrams before. So from the point of view of B, from B's point of view, so they're going to make 4 payments that they already know about, which is 1.3% per annum. Okay, so this is the 1.3. So B's cash flows, so 1.3%. Of course, you have to divide that by 4, but it doesn't matter. Now, the payments, they don't know, except the first one. The other ones, because it's floating rate, so every 3 months, you're going to have a look at what is the 3-month LIBOR. So over 12 months, there will be 4 payments. Now, one thing that maybe you are aware, maybe you're not, the reason on the fixed side is 1.3 is that there is actually a market for these individual floating rates. So if you want to lock them in, there is a market, is an interest rate derivative market where you can lock them in. There are futures contracts, and the prices are constantly changing every single moment. The reason this is 1.3 at the bottom is that when you look at these individual futures markets, okay, and then you take all of them and you take an average, okay, it is likely to be something like 1.3. Are you with me there? Yeah? Now, actually, hello. Hey. You would find that this very, very simple idea is used to price practically anything in the swap market. It doesn't matter whether it is simple interest rate swap or volatility swap or oil swap, currency swap, whatever. It's always swapping something that you know for sure against something that you don't know. But when it's something you don't know, there are estimations on all of them. Okay? Is everyone okay with that? All right, now, I take this idea one step further. So I just talked about a 1 year IRS. So 1 year, you know, in terms of discounting, isn't really that interesting. Okay, now let's say a 10 year. All right, the idea is actually the same, exactly the same, but now instead of having 4 floating rates, guess what? You're going to have 40 of them, aren't you? Okay, that's all. Now, and then down there, you're going to have 40 fixed cash flows. All right. Now, let's just say that the 10-year swap is now trading at 2.5. Who's paying floating? Okay, he's paying floating. Let's just say it's 2.5. Okay, for 10 years. So what that means, again, is that if you pay someone a 3-month LIBOR 40 times, currently they are happy to pay you 2.5% fixed. Are you with me so far? Okay. Now, of course, that simply means when you look at all these little cash flows, there are markets for all of them. There are futures markets. Actually, when you get out to 5 year and beyond, it becomes almost non-existent, but the concept is still there. So when you add them all up, well, you don't add them, you take the geometric average, okay? The average is likely to be 2.5, okay? Everyone is okay? All right, now I get to the next point. And if you follow me so far, okay, the point that I really want to make is, suppose I was to ask you, okay, give me an estimation on the present values of all these cash flows, the PV of them, okay? And you're gonna, I think for most people, the first reaction will be, oh, what? But we don't know what they are because they haven't happened yet, okay? That's the first reaction. It is true, okay? How about give me the market estimate of the present value. So the market always has a view, whether it's right or wrong doesn't matter. Okay? But what does the market actually think they should be worth? Okay? Now how would you do that then? How? You can't, because you don't know what they are, right? But it is actually possible. How? Very good. Did you hear what she said? Oh, you should. Did you hear what she said? She said you can use the fixed rate, or to be more precise, the fixed rate equivalent. Because if you are swapping one thing for another, you imply that their values are the same. Okay, so the fixed rate is basically a numerical summary, if you like, of what the market thinks those future cash flows will be. Okay, now, then one more question. Suppose the 10-year annuity point or PV01 or PVBP or whatever is equal to 7. Let's say it is equal to 7, okay? Then can you give me a precise answer of what is the value on the PV of a bunch of cash flows like this? If the, or annuity value, if you like, I'm really giving you a clue. Annuity value is equal to 7, or annuity point is equal to 7, then how much is this equal to? This bunch of cash flows here. First person who can answer, scan on this. Just give yourself two points. How much? 17.5. How did you get that? There are two numbers. There's a 7, there's a 2.5. There are only two things you can do. Either you add them or you multiply, right? 17.5 is the right answer, okay? Is everyone okay with that? Now, this is kind of important because, yeah, I might have. You just give yourself 2 points. Because this brings me to the what's the best way to do this? Okay, I'm going to try and split the screens. Another thing by way of admin and housekeeping is that, and I have probably already said this, Ryan likes to make notes in the lecture. So all of these are uploaded every week. So this is actually last week. Okay. Now I want to focus on this one, and also the page after, which I think was causing a lot of confusion. And there's a likelihood that something like that can come up in the exam. So I like to just pay some attention to it. What I like to do is I'm going to split the screens. I'm going to split the screens. And so let me do this. Why is it 17.5? Yes, I can. Give me a minute. Now, it is seven. First of all, I don't know what is the estimated present value of this bunch of cash flows. I don't know that. Okay. What I do know is that within the current swap market, if I promise to give away these cash flows, somebody is happy to pay me 2.5 every year for 10 years. Okay. So that means the estimated PV for this bunch of cash flows must be the same as the PV of this bunch of cash flows down at the bottom. And the way you work out the value of this bunch of cash flows now is $2.50 a year over 10 years. I want the present value today is not 25. You don't multiply by 10. I mean, sometimes you can when interest rates are very, very low or even zero. Okay, but when interest rates are higher, there is this thing called the discount factor. I think some of you mentioned that earlier. So when I say the annuity value is 7, or the annuity point is 7, or the PV01, the modified duration, oh yeah, you can add one more here, call it the discount factor. Okay. Again, same concept. Okay, the discount factor. What do you get when you discount a stream of cash flows, regular cash flows, over 10 years, and if the discount factor was 7, okay, then you simply multiply this by 7. That's where the 1750 comes from. Okay? So like I said, these things you have to be good at it. They're very simple, but you just need to know what to do, okay? You have to be fast. Multiplying $2.50 by 10 is very fast, okay? But it's the wrong answer, okay? So you got to be fast and you got to be correct. Now, if you're okay with that, I actually printed out that particular page that Brian, so everyone can get a copy. There should be enough to go around. And you know, just one thing. It's double-sided. So just take one and then just pass it on. Okay. I want to kind of focus on that for a moment. And I think it's worth doing that in some detail. Now, the first thing I want to say, don't look at it too much. Don't study it for now. Okay? I just want to tell you what is the kind of story behind it. Okay? The story is this. The story is that okay. So I think there are a number of things I can say about investor behavior. A number of observations I can share with you. Okay. The first observation is that ever since the global financial crisis, which is now 10 years ago, right? You were very young at the time. So was I actually. 10 years. Ever since that time, the regulators and central banks all over the world, unfortunately, they sometimes take a rather negative view on credit derivatives. Okay? I think that's one of the casualties, one of the big casualties of the global financial crisis. Rightly or wrongly, they take a rather negative view. So quite often,
in some countries, banks are either not allowed by law, or maybe internally within the bank there are very serious restrictions for them to trade in the credit derivative market. Now that's a pity, okay? Because not everything to do with credit derivative is evil. Okay? It can be very, very useful. Okay? But anyway, let's not get down that topic. Okay? So a lot of banks are not able to deal credit derivative. But the market is still there. Okay? You can still buy and sell protection. And I think Ryan used the example of the Republic of Philippines, for instance. Probably a good example. So the banks there, I don't know exactly, but I'm guessing that they have very serious limitations to trade in the CDS market. They're not allowed to, maybe, or don't want to, whatever. Okay. But the market is still there. So you've got these bankers, Philippine bankers, okay? There's a credit derivative market which is global. Okay? Anyone can trade. You can trade if you're from London, from New York, from Kazakhstan, there's no limitation. But so I am the bank, I am SocGen. Okay? So I come to you, you are the Philippine bank. Hey, I understand you can't trade CDS, but guess what? How about I turn around, I trade it, and then I sell you something else, so you don't have to trade it. And the reason you would do that is very simple, because there's money to be made. Right? So I do something, there's a profit, and we share it. I give you most of it, hopefully. Okay? I keep a little bit. Everyone's happy. Okay? So that was that trade that Ryan was kind of showing you. Okay? And I will go deeper into the numbers in a moment. Okay? But that's the psychology behind it. Is everyone okay with that? Yeah. What more can I say? Oh, I can tell you one more thing. Okay. So from my experience, this is very common. This is very, very common. If one day you become a fixed income sales, you're going to run into it. You will remember what I said. All the many bond investors, okay, are far more comfortable with a local triple B than they are with a global triple A. Okay? If you ask someone, some dude in Manila, okay, would you prefer to buy AAA rated General Electric bonds, or would you prefer to buy triple B rated Republic of Philippines government bonds? Now, apart from the fact that GE bonds will give you a much lower yield, apart from that, okay, they're actually much more comfortable taking risk on triple B rated government of Philippines. They know it. It's just around the corner. And they're thinking, yeah, well, if the Philippine government collapses, that's not problem. Okay? And it doesn't only apply to governments. Okay? They are a lot happier to buy poorly rated, maybe Philippine corporations, than they are to buy, well-rated, let's say, European companies, because they feel they don't know them. Right? So you see that quite a lot. Right? That's just an aside to share with you. Now I want to, first of all, try to explain to you how that trade is supposed to work. And then I will go through the numbers, which is actually on the other page when you flip them over. Okay? Don't do that yet. Yeah, so the trade is this. The trade is based on the observation that this client Phil Bank, this is not the Philippine Central Bank, just any kind of commercial bank in the Philippines, okay? So they cannot trade CDS, but they are happy. So what they're doing is what they would do. Now, if I have to redraw the schematic diagram, then what they would do, so let's say SocGen is the one behind this trade, okay? So what this customer would do is they would give a bond issued by the government of Philippines to SG. Okay, now, by the way, this is a US dollar bond. Okay, so 100 million US. That is the face value, okay? Face value. Now, the bond itself may well cost you more than that. In fact, in the example that he showed, the bond was trading at a premium. The price was 110, as you recall, okay? So it's trading at a premium. So the price is 110, and it pays a 4% coupon. Now that's the bond. So for the client, what they do is they would, if this is the bond, it's just a piece of paper. So you give this piece of paper to SocGen, and what do they give you? They actually give you 70% financing, okay? 70% financing. Now that actually means they have to give you $77 million because the bond is trading at a premium, okay? You can kind of see that, that's this part here, 100 million times 110% times 70. If some of this is confusing you, just keep an eye on the timer there, and you can go home if you want to watch the video. It will be approximately, I think I started around 35-minute point, somewhere around there. Okay, so that's the trade. Now, so immediately this client is quite happy because now they don't have to get $110 million from their pocket in order to do this trade. They only need, what, 33 million of their own money. Now, not only that, so this is basically, this is the repo, right? This is the repo. Now, and this, I guess this is the part which drives the whole thing, okay? Now, SG is going to go out to the credit derivative market. So first of all, when they take this bond, SG is going to go to the bond market and they're going to sell. They are going to sell 70 million. That's the face value. Okay. Now for that, they will actually get $77 million in cash. Okay, so they sell, basically they sell 70% of the bond. In his diagram is the one which is down here. Okay, and then they keep the other 30%. Okay, now the other thing they do is they will go to the CDS market and they will sell protection based on
a 77 million notional, not 70, 77. Okay, and he's saying that you get paid 1.2% or 120 basis points, if you like, on that CDS. Now, this is something that the Philippine banks normally will not be able to access or do not want to access. That's the whole point. So the SG derivative desk sits in the middle and try to take advantage of this. Okay, there's something you want, but you can't get it. Don't worry, I get it for you. Okay, and then I just keep a little bit of money and then I sell you something else. Now, that is the trade. That is the trade. Okay. Is everyone okay? Yeah. Why does it make money? If you flip over to the page, the other page, okay. Now I'll go through this. I'll go through this slowly. And like I said, if you don't get it, you can always go home and listen to the video. The way it works, so he's got money coming in. So this is actually from SocGen's point of view. Okay, the money inflow. So first of all, when you sell the bond, for, so it's $100 million, but it's trading at a premium, but you only sell 70% of it. So you are going to receive $77 million. I'm going to ignore the millions. Okay, I'm just going to use par. So that money comes in, and on the CDS, you are going to receive 1.2% on 77 million. Now, this is over 10 years. Now, this is where the annuity question becomes relevant, okay? If you look carefully at his writing, he's got times 7. Perhaps you're wondering, where does that 7 come from? We assume that the discount factor is 7. Doesn't have to be, okay? But let's just say it is 7. When you multiply it all out, you do actually get 6.468. That's where that came from. You can check that. Is that correct? Yeah. Okay. So in terms of par, if you deal $100, then the CDS will actually give you around $6.47 in today's terms. Okay. I'm going to ignore all the millions. I will put the dollar signs where it's appropriate. Now, the other thing is, one thing I have not mentioned, which is when SG gives the money to this Filipino bank, in fact, they are kind of lending them $77 million over 10 years, and they are charging them LIBOR plus 50. You can actually see that here. Okay, I can actually call up. If I show it here as well, then it might be easier. I need to flip it. Okay. Rotate. page 1 to 7. Clockwise. Okay. So what you're doing is when this is, I assume this is SG. So when they lend money to the Filipino bank, they lend $77 million. They're going to charge them, and they will charge them LIBOR plus 50 for 10 years, 50 basis points. Okay. Now, if you need to estimate what that is up front, and again, this goes back to the point I was making earlier, he made a further assumption that the swap rate is actually around 2.5. Okay, so a lot of things here he probably talked quite fast, and he said this is a 7-year trade. It cannot be a 7-year trade. I think he meant a 10-year trade. If it was a 7-year trade, your discount factor wouldn't be 7. I think maybe you got a bit confused. So this should be a 10-year trade. All right. Are you with me? Just one change of the number there. A 10-year trade. So discount factor 7. Okay. So swap rate is a 10-year swap rate. Now, so if you recall what I was saying to you a bit earlier, you want to estimate the price of a bunch of cash flows. Now you want to estimate the value of dollar LIBOR plus 50 basis points over 10 years. You want a PV of that. Well, how the hell do you do that? Okay. How do you do that? How? Well, first of all, if you look at the 10-year swap rate, if it is indeed 2.5, if it is 2.5, then so that means to do a 10-year swap, you pay someone LIBOR, they are happy to pay you 2.5%. That simply means if you pay them LIBOR plus 50, they are happy to pay you 3%. Okay? So you then work out, so this is how you can do a very quick sort of back of the envelope estimation. So now you know, oh, this is equivalent to a fixed rate, a 10-year fixed rate of 3%. And we set the duration, or the annuity factor is 7. Okay? So over a 10-year period, that would actually be so 3%, because this is the fixed rate equivalent of receiving this amount of floating rate. Okay, so 3% times 77, that is the amount of money you are lending to the client, times 7. What does that equal to? A lot of 7s. $16.17. Do you see that number on his scribbling? It's right here. Do you see that? 3%. Thank you for asking. So I just said to you, if you assume that the 10-year swap rate was 2.5, and he gave that, he provided that, it should be 10 years, not 7 years. Okay. So if the 10-year, the trouble is sometimes he talks quite fast, and then maybe you missed the important detail. So if the 10-year swap rate was 2.5, and that's this number here, okay, it's on your sheet, then that means a series of cash flows over 10 years on just LIBOR would be equivalent to 2.5%. So LIBOR plus 50 would be equal to 2.5% plus another 0.5%, which is 3%. Okay? Is everyone okay with that? Okay, and so now we got 16.7. Now, it doesn't end there, running out of space. There is one more. Now, don't forget, so SocGen actually sold 70% of the face value. They actually kept the other 30%. Okay? So they're going to get a coupon from there, and the coupon paid is 4% times 30. Now this time I do have to use just the face value and not the premium price. Okay, and again I use the annuity factor or the duration. You see how important this is. The number 7, it keeps turning up every single time. Okay, now this one would be 8.4. Okay, so this is all the money that SocGen will actually receive. You actually can add it all up and see what it comes to. Okay, I think he just made this trade break even. Okay. You notice that I was just trying to figure out. Now I get confused. Now there are a couple of other numbers here. What are these? This is actually at maturity. Okay. Now at maturity, if the client, the Filipino bank, if they are well behaved, they will pay you back the 77 million. So they should pay you back. So that is also a cash inflow. And then the Philippine government bond, when that matures, you also get a payment from that. So here you actually get 107, okay? 77 plus 30. So let me just wipe that out. So the other, but that's kind of trivial, okay? So this is bond sales proceeds. This is on day one. And then this is the CDS. This one is the repo borrowing costs. And this is the government bond coupon. Now you do get a couple more cash flows, but they actually happen at maturity. So these ones, there's a $77 payment at the end, and there's a $30. You can't add them up because the top 4 are happening at the start, and the last 2 are happening at the end. But anyway, the money outflow, what do you need to pay? Well, it is actually quite simple. Money outflow. The first flow you have is you gotta finance your client at the beginning. So it's $100 times the premium but you're going to finance them 70%. So you give them $77 at the start, okay? And then you are going to pay them 4% coupon over the face value, okay, for 10 years. So again, this number 7 turns up here. So all the coupons you're going to pay them would amount to $28, the present value, that is, okay? And then at maturity, you are just going to pay them back 100. So you got 77, 28, and 100, which when you look at your, that's where they are, 77, 28, 100. Okay? So when you add up all the numbers, actually, the reason I got confused, he wrote down 205 here. He was adding up 77 and 28, which are present values, but this one is a future value. So I don't know if you can really do that. But the point being, when you add up all the numbers of the inflows and the outflows, you should be making money. Okay, he did that. He was adding present value to future value, so I'll do the same, although this is really, strictly speaking, is not correct. Okay, but even if you do that, when you add up all the things on the top, well, even if you, okay, let's do this. Inflow, present value, and future value. Now, what do I have here? So I got 77 plus 6.468 plus 16.17 plus 8.4. Now these are all present values. That is equal to 108.4. Okay, so the present value inflow is 108.4. The future values is only this one and this one, which is 107. I don't want to mix them up. You shouldn't really be adding them together. Okay? Now my outflows, then I need to add this one and this one. So that is equal to 105. And then the future value outflow is when I pay back the par value. Okay, you see how much money I'm making? Here I'm making $3.40. And 10 years later, I make another $7, which is equal to $4.90 today in PV terms. So that, ladies and gentlemen, is what motivates banks to help clients when they sit in the middle. They do something that the clients cannot, and then they try to share the benefit. Is everyone okay? The last part, the 100, this one. Now, this is, first of all, what is that? That is a money outflow. So if I'm the bank, this is what I need to pay out. And this actually happens in 10 years' time. Now, in 10 years' time, what happens? If you look at the original, so do not lose sight of the fact that over here, there is actually a repo transaction going on. So what are the obligations? The obligations are as follows. The obligations are at maturity, I'll write that down here. So the field bank needs to pay back. It's called a repurchase. It's kind of funny, okay? So they're going to pay back $77, and the dealer is going to give them back the bond, which is $100 million, okay? Now, the reason I put down I'm going to give them $100, I assume that at maturity, the bond has not defaulted. So whether I give them the bond on the last day or whether I give them $100 is actually the same thing, okay? So this is actually me giving them the bond back on the last day, which will be equal to $100 anyway, okay? Thank you, that's a good question. Maybe I skipped one step. Do you understand now? Yeah? Okay. Now, this is real finance, you know, this is as interesting as it gets. And they really do trades like that, okay? I think I have explained just about every number that appears here and more, okay? I really believe that this trade should be a 10-year trade, not a 7-year trade. That was probably, maybe it was, so the duration is 7 years, all right? Is everyone okay with that? Yes. Yeah. Oh, did he? Okay. Okay, thank you. Because after I go home and I see that everywhere he multiplied by 7, I assume that must be a 10-year. Okay. Well, that doesn't change the logic of the trade, but I thank you for that comment. Okay, then I kind of, I've overinterpreted his numbers, okay, but the logic still stands. Okay. The logic being, there's a client, they want to do something and they can't do it. You can. So it's like, oh, there's $10 on the floor. You want to pick it up? They say, I can't, I've got that penny. Okay, I'll pick it up for you. How about I keep $2 and I'll give you the other 8, right? That's kind of what's happening. Okay. I think I want to okay, there was another question last night that so we talked about annuity value, which is actually quite important. I was going to share with you some stories about Argentina. We can do that next time. There was something else that I overheard that I think is worth sharing with you, but I need to have a look at his notes. Just bear with me a second. Okay. So I've already, I think do it here. This is it. These are his lecture notes for last night. There's actually, I want to talk a little bit about the quiz. That's what I wanted to do. This was the quiz. And let me just try and open that. Okay, now this was the quiz of last night. Can you actually read that? We may not have enough time to go through the answer, although it is quite simple. But what I do want to say is that so this one is a funded transaction. Funded, okay. Funded, as you know, or you should know by now, it means that when the client comes to you, they are not just doing a simple swap with empty pockets. I give you something, you give me some. Funded means they give you $100 to buy something. Okay, that's an important point to realize. Now, so what goes on here is that so there's the investor or customer. They come here and they on day one they give you $100, and you are the issuer, so you might be SG or whoever. And typically, two things will happen. Okay, first of all, you need to go to what's called the money market desk, which is another desk, you know, in the dealing room. Every bank has one. Okay, you give them your $100, and they will give you an income, which can either be dollar LIBOR plus something, or it can even be a fixed rate sometimes. You know, either way is fine. Okay. Now, then what you can do is you go to another desk, the derivative desk. Now, it doesn't even matter what kind of derivative you are dealing. Commodities, forex, interest rate, credit, it doesn't matter. Okay. So you have some money. So if you want to buy options, you simply pay them with that money that you have, and you get some kind of funky payoff, and you provide that funky payoff to the customer. Okay. Now this is what normally happens. That's what's happening with this trade. Now, for now, I think we won't go through the numbers because it's been quite intense today. We can do that next time. What I do want to say is this. So here, and this is an important point, all right? So the issuer is giving the money away to the in-house, the internal money market desk is another department or another desk. Now, in practice, this money market desk is free to do what they want with that money, as long as they pay you the 2%. Now, of course, all banks, they have guidelines on what they can do. So you cannot just go out and buy some junk from Argentina or whatever, okay? You can't do that. So there are guidelines on what you can do and what you cannot do. Now, the problem is, this is how it used to get done, okay? It's still done like this a lot, but after the financial crisis of 10 years ago, a lot of customers, they don't trust the banks. They said, we like your products, we love your derivative capability, but we don't trust your bank to do something safe. So they said, instead of giving it to the money market desk, how about you just go out there and you buy treasuries, US Treasury. You go to the Treasury market and you buy treasuries, okay? Now, if you do that, two things will happen. Number one, so now this bond that you buy from the Treasury market will be linked exclusively to this transaction. So now the client is comfortable, okay? So they know where the money has gone to. Now, that's number one, okay? Number two, if the original money market can pay you 2%, Treasury probably can only pay you 1.5. There's no free lunch, which means when you go out there and you buy options, instead of 2%, maybe you can only afford 1.5%. Okay, so that's the downside if you want. Okay. So when you see this trade, and Ryan writes here collateral UST 2.7, that is what he actually meant. That's the background behind it. That is the story behind it. Some people are asking, what does it mean collateral 2.0? Why do you need to post a collateral? No, you don't, okay? But some clients are now requesting banks, they say, look, I'm happy to trade with you, okay? Just don't give your money to the money market, please. I don't trust those guys, okay? So go out there and buy a piece of treasury. I don't care if the yield is lower. You go out there, you do that, and you tell me what you've done, and you document that. So in case one day if your bank goes bankrupt, at least I can still get back that treasury. That's what the collateral means. Is everyone okay with that? Yeah? Because you just look at a word like, oh, collateral, yeah, what's going on here? Okay? That is the background. Okay? It's now nearly 2:15. I was hoping to share with you a story about Argentina. I might do that next time. But just as a preview, maybe I can at least play a little video here. If the link is working, let me do that, and then we can just go off. Okay? Argentina. Okay, as you know, so Argentina has been in a bit of trouble recently, and we talked about that 2-3 weeks ago. They tried to jack up the interest rate to 40% in order to give some support to the currency. At that time, I already said it wouldn't work. Never does. Okay? And it didn't work. So they've gone to the IMF now. Okay, I'll play you just a very short video. What IMF support means for Argentina. Hold on.
Esta nueva situación y de manera preventiva he decidido iniciar conversaciones con el Fondo Monetario Internacional.
This is the president.
Para que nos otorgue una línea de apoyo financiero.
Do you know who this woman is? Her name is Christine Lagarde. She used to be the finance minister for France. She's now the chairperson of the International Monetary Fund, IMF. And when she comes to your country, when she comes to visit your country and starts shaking hands with your government officials, it is often bad news. Okay, so this is maybe the woman you need to avoid. Nothing personal. Okay? So they had a financial crisis in the year 2001 to 2002. There was a lot of hardship. And many people blamed the IMF at the time for the help that they were giving to Argentina. And actually what the IMF did in the end triggered a massive $100 billion default and a crushing devaluation. Okay? %20 unemployed. Anyway, that's the background. Okay, so next week we'll talk some more about that. It's a very interesting story. Okay, I'm gonna let you go. So thank you for coming. And for those of you who haven't signed in, I will flash up the QR code again. Okay, have a nice weekend.